Imagine walking into a bank and asking for a loan. The bank hands you the money today, but you promise to return it later. That simple promise is called credit. The word itself comes from the Latin creder, meaning to trust or believe. So every time credit is given, trust is at the center. The lender trusts that you will pay back, but here's the catch. Repayment is never guaranteed. It's always uncertain, and that uncertainty is where risk begins. In every credit transaction, there are always two sides to the story. On one side is the borrower, also called the obligor or counterparty, the one who receives the money or service. On the other side is the lender or creditor, the one who provides it. The borrower makes a promise for future payment, and the lender evaluates whether that promise is reliable by checking income, reputation, and financial strength. Only after this assessment does the agreement move forward, but even then, nothing is 100% certain. This uncertainty leads us to what we call credit risk. Credit risk is simply the chance that the borrower fails to pay as agreed. Maybe the payment is delayed, maybe partial, or maybe it never comes at all. Whenever payments depend on future performance, risk exists. This is why loans, bonds, and even small business invoices all carry credit risk. It's not just a banking problem. It's a part of everyday business life. Now think about how losses actually happen. A borrower might completely default, meaning no payment at all. Sometimes the probability of default turns out higher than expected. Other times, the amount exposed is larger than we estimated. And even if default happens, we may recover less money than planned. So the total loss depends on three things: the chance of default, the size of exposure, and how much we recover. If any one of these goes wrong, losses grow quickly. Credit risk appears in more places than we notice. Suppose a mechanic repairs your car today and allows you to pay after 30 days. Or a company delivers goods but waits for payment later. Or a buyer pays in advance and hopes the seller actually delivers. All these situations involve time gaps between payment and delivery. That gap creates risk. Only pure cash and carry transactions avoid it, but in the real world, most businesses rely on credit. Let's make this real with simple examples. A car dealership fixes your vehicle and sends a bill later. What if you don't pay? A university pays up front for training services. What if the trainer never shows up? A supplier sells expensive equipment and allows payment after 30 days. What if the buyer goes bankrupt? Even banks face the same issue when customers miss loan installments. Each of these is a small story of credit risk in action. Broadly, there are two main types of this risk. The first is settlement risk, where one party delivers goods or services, but the other party fails to pay. It's about timing mismatches. The second is financial obligation risk, which comes from formal loans or bonds where borrowers might fail to pay interest or principal. Settlement risk is common in trade, while financial obligation risk dominates banking and lending. Different names, but the same core problem. Promised money might never arrive. This is exactly why credit risk matters so much to banks. Banks don't operate on cash sales. They take deposits from savers and lend money to borrowers. If borrowers fail to repay, the bank still owes money to depositors. So defaults directly hurt profits and capital. Credit risk is unavoidable in banking. It's part of the business model itself. That's why managing it is not optional. It's survival. To protect themselves, lenders use several strategies. They carefully analyze a borrower's financial statements, set credit limits, demand collateral or guarantees, and diversify loans across many customers. They continuously monitor borrowers and take early action when trouble appears. The goal isn't to eliminate risk. That's impossible. But to control and minimize losses. So in the end, credit risk is simply the risk behind every promise of future payment.